Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am Pushpendra Mehta, and my guests for today are Jack Large, editor of CTMfile, and Craig Jeffery, managing partner at Strategic Treasurer. Welcome to the Open Treasury podcast, Jack and Craig. This week, we are focusing on 5 stories covering 5 themes, namely payments, economy and interest rate hikes, recession, currency management, and tech partnership. You can read these articles and also research content more deeply by visiting CTMfile.com or by following the links in our show notes. Let's begin our discussion with the first story that is about the US Federal Reserve launching a new service named FedPayments Insights, a business and analytics tool to assist financial institutions in tracking trends for Fed ACH payments, as well as information on pertinent operational, strategic, or risk management decisions. Craig, what do you think are the salient features of the FedPayments Insights that will make it a useful service for financial institutions?
Well, I think that in this era of things are faster, we need to be able to see and monitor activity and leverage the data. That's certainly true in the payments arena, and certainly for the U.S., the ACH network is extraordinarily important. So the fact that this is becoming available, I would have loved to have seen it multiple years ago. This idea that we can see data way after the fact just doesn't seem appropriate for volumes that are flowing through. And so this, I think, helps rectify it so we can see the information, the flows, and do analytics more rapidly. This is very valuable to banks. I think it's much easier to catch and see and spot trends earlier because it's closer to real time. That's the biggest item from there that I would say. It's much more of a reflective of more current data rather than really old, ancient data.
As an observer from the outside of the US, the one thing that all my corporate treasurer friends and colleagues have said is when a check's going to disappear. I think this is a good example of where the payment systems and the NACHA and other electronic payment systems are removing the need for checks, which is a burning desire of lots of people. So I wish this service well. I think it'll help, but the habits change very slowly.
Yeah, you're right, Jack. I mean, when are checks going to disappear? I don't know. We're seeing less checks. We have all these services that are actually highly efficient. Like it captures the check and puts it as an image and settles it as an image. It would probably convert much faster if we were still sending the paper around everywhere. And so we're still originating way too much that way. And it's, keep making fun of the US on that. Maybe we'll eventually stop sending checks. I mean, at least we stop the movement of paper very far. It gets moved to the endpoint and then it becomes an image. But still, it's still way more expensive, far more inefficient than ACH, for example. So
the change of royal family has introduced something that shows exactly what's needed. £20 notes and £50 notes and £100 notes, if they got the Queen on, they're no longer currency after the 1st of October. And so all of a sudden people are finding them all over the place and really getting rid of them. Okay, you can go to a clearing bank and still get rid of them, get value for them. But this is an example of the absolute things that need to happen if you're going to get change in payment systems. The Queen's head will no longer be on the £50 note, £20 note, and so on.
So are all the notes going to be valueless after the 1st?
Are you asking this on a personal basis?
I am. I do maintain a small supply of euros and pound sterling.
Yeah, for when you travel. No, but you can go to a clearing bank and get value for them. It's just you can't do it in shops.
I didn't want to get too gloomy. And thank you for being able to point it out that it was personal. Awesome.
I have another story here. I too had forgotten some time ago to take the notes to a local clearing bank. So I had to go to the Bank of England and stood in a queue amongst the top-hatted guys who show you around. This woman in front of me, she was nervous. You could see she was twitching, and she'd got bulging pockets and so on. And she got to the head of the queue and she said, "My husband's a builder and he got paid in these." And she emptied her pockets of £7,000 worth of notes and said, "Hope you can give me value, otherwise I'm a dead meat."
Well, moving from the promising story going around in the US regarding payments to our next story about the 0.5% interest rate hike in the UK. Last week, the Bank of England announced its 7th interest rate hike in less than a year, despite forecasting a recession as it battles the highest level of inflation of any G7 economy. UK's central bank repeated last month's hike of half a percentage point, taking rates to 2.25% from 1.75%. It said it expected inflation to peak next month at 11%, lower than it previously expected because of government intervention to subsidize energy bills. Compounding the economic woes, the pound fell to a new 37-year low against the US dollar last week, which means a weaker currency will result in the UK having to pay more for imported energy and food, adding to its inflationary pressures. Jack, if I may start with you. Given the pound slump, the rising borrowing costs for UK corporations, an unprecedented energy crisis, and widespread supply chain disruptions, if you were a corporate treasurer, what would be uppermost in your mind, knowing that combating inflation in the UK is going to be a rather daunting task?
For corporate treasurers in the UK, or corporate treasurers with business in the UK, the issue is that you've got the government going in one way, which is causing panic in the foreign exchange markets, and you've got the independent Bank of England pushing for inflation control. And we're already seeing forecasts in the market of the interest rates in the UK going from 1.75 to 6% in early next year. So the corporate treasurers have got to keep that in mind as they manage their assets and their business in the UK. I'm not sure how it's all going to turn out. It's mad.
Yeah, I think this is a repeat of week over week, and I'm surprised you keep having us on because we're so pessimistic about a few of these economic items. Interest rates are being pushed up by the different central banks. Your comments about the Fed and the Bank of England. Almost every single central bank is raising rates, and primarily to combat inflation. And so we're dealing with the challenges of inflation, high energy prices. It's a rough sea. A lot of moving parts. Caution is warranted, ensuring you have enough liquidity. I think there's every expectation that interest rates will rise, and managing that is the order of the day. Given the increased expectations of deeper recessions, or areas that aren't quite in recessions will move into recessions, the playbook for being cautious, securing liquidity, working on your financial supply chain, your receivables and your payables. All of those are, that playbook has to be out and be run right now.
The third story revolves around what you mentioned, the likelihood of a deeper Eurozone recession in 2023. Deutsche Bank forecasts deeper European recession amid a war-fueled energy crisis. Hopes for a mild recession in Europe this winter has been abandoned by Deutsche Bank strategists who have dramatically slashed their 2023 growth forecasts. The bank now expects EU area growth to decline 2.2% in 2023 from a previous forecast for a 0.3% decline. Craig, given that Europe is stuck in an energy crisis that is likely to worsen with winters approaching, do you think even a recession over the winter will not be enough to reduce inflation without further interest rate hikes?
I think that's well beyond my ability to project. I wish we could point to some economists who thought that. I mean, inflation's skyrocketing. The energy issue is going to be severe. So I think it's we hope the winter is mild and that people can serve what they can. There needs to be more production. The winter's here. You can't fix everything with a long-term fix in a short term. The winter's almost here for Europe. It's imminent. So it's a fairly serious thing. And I think that these projections don't seem to be that drastic. The situation could be significantly worse. Hopefully we're skipping lightly through a recession and coming out of it, but there's a lot of signs that point to, at least a mid-size level recession, continuing to deal with inflation. I mean, these bumps of 25, 50, and 70 basis points don't seem to be slowing inflation in a number of the markets where the central banks are making those changes. And then, of course, the other concern that I have is they're always adjusting, trying to play catch up, and then they go too far, and then they have to ratchet back. And we see that time and time again because mostly you're driving by looking at data that's in the rearview mirror, and it's hard to navigate that correctly. Like nobody would want to drive their car looking in the rearview mirror, and so you're taking estimates about the future, and it's problematic. There's potholes, there's other vehicles on the road that you have to avoid.
My opinion is that people like Jim Reed are really good at their job and are really good at analysing trends. The thing that I picked out of their work was that they talk about stagflation. If that gets endemic, it's very difficult to get out of. I can't see the current tools that we've got being adequate to deal with the inflationary pressures from Russia's invasion of Ukraine and the consequent reactions to that. We're starting to see things that are happening that are going to get embedded in the way business is done throughout Europe. And this is going to be very difficult to escape from.
Yeah, it's been a while since we've had stagflation. This was the 70s and the 80s, very stagnant economy, economic malaise, but high inflation. And those are not normal times. And like you said, it can stick for a long time.
And it gets into the way society works and the way society thinks and the way they do business. And it affects the business decisions. It remains to be seen exactly how it'll play out, but that's the way it's going.
The fourth story for today is about the Japanese government propping up the yen for the first time since 1998. Japan's yen began this year trading at 115 to the dollar. It started weakening in March and slid past 125 in April, breaking an important psychological barrier. By September, the yen had tumbled past 140, leaving markets to wonder what, if anything, would trigger defensive action. The answer came on September 22nd as the yen nearly reached 146 to the dollar. Japan's government stepped in to bolster the currency by buying yen and selling dollars. The forces dragging the yen down are formidable. The main one is the growing gap in interest rates between the Bank of Japan and other central banks, which drives investors to dump the Japanese yen in order to buy American bonds that offer higher yields. Jack, do you think the Japanese government's intervention will fix the Japanese yen's currency's underlying weaknesses that centers primarily around the Bank of Japan keeping interest rates at rock bottom levels while other central banks are conducting outsized rate hikes?
I'll answer your question in a minute. But the most interesting thing about this is how they were open about how they are interacting with other countries as they try to manage the currency. What Japan is doing, what a lot of the other central banks are doing, is they are not just talking to their banks within their country, they're talking to other central banks, and they're collectively trying to manage the turmoil and the volatility. And that's what's going to drive the whole way we manage this. The interesting thing about Japan is they have managed to not increase their interest rates very much at the moment. and I'm pretty certain they will be successful, relatively speaking. So it gives their industry an advantage over other industries in other countries. I think they're doing a better job than the Bank of England at the moment, as far as I can see.
Maybe they are doing a better job than the Bank of England, but the idea that they're selling a lot of U.S. dollars to buy yen can only be temporary. I mean, if the cause is due to the interest rate differential, this arbitrage on the investment side will continue to pressure flows, right? I mean, just changing the supply demand of the currency by releasing U.S. dollars is temporary, and there's only so much room they have to play with it. So if they see this as a very interim or passing item, then it could work, but it's not sustainable because, water will return to its level, and there's a difference here. And so how long is this a plan for? I think that's another question. I'd love to hear any other thoughts on that, but it's not sustainable. It can work in the short term.
I agree entirely about that. It's just that the attitude of the central bank seems to me different from other central banks. They are protecting industry as much as they can, far more than the other banks are doing, where they're combating intra-country inflation that is causing havoc. We'll see how it plays out.
Right. Yeah. You have to think about the levels they have. They can sell currency or buy currency. There's only so much they can sell or buy. They can change interest rates. Well, they can make adjustments there. I mean, they're still negative. And there's really not necessarily a limit to what you can do other than how the market will react. That one lever can only go so far. It runs out.
Moving forward, the Finnish software company Nomentia announced that it is partnering with Sweden's SEB to provide integration and bank connectivity to SEB's clients to prepare them for the upcoming changes endorsed by P27, the Nordic payments platform. What do you think of the Nomentia-SEB partnership?
Well, I think this is great for Nomentia. I think a number of banks like SEB partner with tech firms. I mean, connectivity is a huge element for banks to stay deeply connected over a long period of time, and that the integration has efficiency benefits and has long-term relationship implications, right? The more deeply you connect, the more you stay with your bank, and you connect with your banks that are more important. And so making it easier to do business is always a winning solution. And this is an example of a good partnership that benefits both SEB and Nomentia. Other banks do that across the globe. Some banks have a dedicated group that does this and offers it as an outsourced service, like Credit Suisse has Fides. That's another example. And there's a number of treasury aggregators that do this. So I think this is a wise business activity and thinking for these two institutions.
The importance of this example is that what you got is a company that is superb at doing its particular job of connectivity, and they know much more about the ins and outs of the other banks' communication protocols and habits and the way they do business. And so the third-party use of Nomentia is incredibly important as an example of how the whole industry is moving to getting specialist people and companies and practices that are bank independent. So if SEB change their internal processes, it doesn't matter for the corporate. The corporate is interested in stability and efficiency, not in changes. They want to get on with doing what they do best, which is making widgets or whatever. Nomentia is a good example of how good quality third-party providers are now starting to work with banks directly, not just for corporates.
Finally, I would like to wrap up this conversation by seeking your opinion on your choice for the biggest or the most important story of the past week and why. If I may start with you, Jack.
For me, the number one story is Japan having to deal with global turbulence as well. It's not independent for any one country. It is a global problem. And this global volatility, inflation, and stagflation or some version of recession is with everybody. You've got to believe it when Japan is reacting. It's a very important example of what's happening.
I was going to say the same article for roughly the same reason, but I'm going to pick another one because Jack covered that, and you want some differences. I think I'm going to go with the UK holding off or moving more slowly on raising interest rates. I think that's notable. I mean, Japan is making some significant moves that will leave them with less options to address things, and I think UK's movements are slower than some other countries, which will probably catch up to them soon or soon enough. And I think it's just we're getting to the point where the pressure is enough in a number of the areas of the economy, from inflation across a number of elements, not just energy, but food. And it's the ongoing interest rates that are bumping up mean that this reckoning's coming, and all the banks are playing catch up. Some are trying to get caught up more quickly, but the fact is it's still catch up, and those that are going slower are suffering worse consequences now. And there's worse currency consequences and perhaps more economic consequences later. We don't know for sure, but that seems a little risky. When the wind has shifted dramatically, you have to tack harder, if we can use sailing analogies, to address it. It seems like certainly some are not tacking as hard as others are tacking. And that will either prove to be very wise, or it will have proved to be not enough when they should have seen others moving in a different direction. I think they need to tack a little bit harder.
A big thank you to you, Jack and Craig, and to our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.